As we check the tape, Opendoor Technologies, ticker OPN, is trading at $7.97, essentially flat for the day, holding steady after what can only be described as an explosive 21.5% rally in yesterday's session. The volume yesterday was staggering, and it's clear the market is trying to digest that massive move. If you were just looking at the consensus analyst rating, which remains a firm sell with an average price target that points dramatically lower, you would have expected this stock to be languishing. The expectation for months has been that this company is a broken iBuyer, a relic of a low interest rate environment, burning cash as it struggles with a brutal housing market. But then reality punched through. A 21.5% single-day surge isn't a glitch, it's a statement. It's the market violently disagreeing with the consensus, forcing everyone to stop and ask what they're missing, and what they were missing was a narrative shift, one that just got a massive stamp of approval from JP Morgan, which maintained its overweight rating and an $8 price target, citing a major transformation underway. This creates the fundamental tension we are seeing right now. The market's prevailing belief has been that Opendoor is stuck. Its recent third-quarter earnings report seemed to confirm this. The company posted a wider-than-expected loss per share, missing estimates. The stock initially fell on that news just a few days ago. That was the reality everyone expected. But the new reality, the one that sparked yesterday's buying frenzy, is that revenue for the quarter actually beat expectations. More importantly, the new CEO, Kaznejiatan, appears to have successfully convinced some of the market's biggest players that this is no longer just an iBuying company, but a software and AI company. This new narrative, focusing on a path to profitability by 2026 and using artificial intelligence to manage inventory and risk, is what investors are grabbing onto. It's a direct challenge to the old bearish thesis. This isn't just about flipping houses anymore, or so the bull case goes. It's about building a high-tech real estate platform. The daily trading action is now a battlefield. Yesterday's 21.5% pop was not just fundamental optimism. We have to talk about the short interest. According to the most recent data, Opendoor has a short interest of nearly 23% of its entire float. That is an incredibly high number, meaning a significant portion of the market is betting heavily that this stock will go down. When you have a high short interest like that, any piece of good news, like a revenue beat or a major analyst upgrade, can trigger a violent chain reaction. As the stock starts to rise, short sellers who borrowed shares to sell are forced to buy those shares back to cover their positions and limit their losses. This forced buying creates more demand, which pushes the stock even higher, forcing even more shorts to cover. What we saw yesterday was a classic short squeeze ignited by the JP Morgan report and the new AI narrative. This brings us to short seller awareness, which is critical for anyone trading this name. The bearish thesis is simple and, to be fair, has been right for a long time. The shorts argue that the iBuying model is fundamentally flawed. It's capital-intensive, low-margin, and extremely vulnerable to macroeconomic shocks like rising interest rates. They look at the company's Q3 net loss and see a business that is structurally unprofitable regardless of what the housing market does. They see the recent talk of an AI transformation as just a new coat of paint on a broken-down car. What's your take on the rising short interest? Smart money or manipulation? It's a question that defines the entire trade. So, what should you be watching? For a stock this heavily shorted, the first thing to do is understand the data. You can find short interest data published by NASDAQ or on financial data sites like Fintel. But don't just look at the percentage, look at the days to cover, which is currently around 1.6. That's relatively low, meaning that, in theory, the shorts could cover their positions in under 2 days of average volume. However, yesterday's volume was multiples of the average, showing how fast that can change. Also, check the borrow fee rate. This is what it costs to borrow the stock to short it. Interestingly, for Opendoor, this rate has been quite low recently, under 1%. This tells us that even though many are short, it isn't yet prohibitively expensive to maintain those positions. A sudden spike in that borrow fee rate would be a major signal that the pressure on shorts is intensifying. We also have to acknowledge the retail sentiment. This stock has history. Back in July, it experienced a massive 400% surge, becoming a full-blown meme stock. Discussions on Reddit and X lit up as retail traders piled in, specifically targeting the high short interest. Yesterday's rally and the new AI buzz are exactly the kind of catalysts that bring those traders back to the table. The new management is speaking their language, and the fight between the JP Morgan bull case and the bearish short sellers is exactly the kind of setup that creates explosive volatility. Let's briefly rewind to the business itself. Opendoor is the largest iBuyer, especially after its main competitors, Zillow and Redfin, shut down their own iBuying operations, unable to manage the risk. Opendoor's model is to use data to make cash offers on homes, lightly repair them, and then sell them for a profit. When mortgage rates were at 3%, this was a high-growth, albeit cash-burning machine. When rates shot up to 7%, the entire model froze. The company was left holding thousands of homes that were losing value by the day. This is the core of the risk. The company's future now depends on two things. First, a stabilizing housing market, which we are beginning to see, as mortgage rates have thankfully pulled back to the low 6% range, their lowest levels in over a year. Second, it depends on whether this transformation is real. Can their new AI models price risk better than the old ones? Can they truly become an asset-light platform, as some have suggested? Or are they still just a capital-heavy home flipper? Looking forward, the picture is incredibly polarized. The bullish scenario is that the new CEO is the real deal. The company uses the new AI focus to tighten its spreads, manage risk effectively, and ride the tailwind of stabilizing mortgage rates towards its 2026 profitability target. In this world, the 23% short interest is just fuel, and every new positive data point could trigger another squeeze, driving the stock back towards that $8 target and beyond. The bear case is that this is all just talk. The Q3 earnings miss was the real story, not the revenue beat. They'll continue to burn cash, the AI narrative will fade, and the fundamental weakness of the iBuying model in a normal, non-zero interest rate environment will be exposed. In this scenario, the shorts will be proven right, and the stock will fall back to its lows. So the tension here is stark. The expectation from the sell ratings and the earnings miss is that this stock should be failing. The reality is a 21.5% rally, a new AI narrative, and a major analyst defending the transformation. The key thing to watch next is whether the company can follow through. We need to see if home acquisition volumes, which management guided would grow 35% in the fourth quarter, actually materialize. We also need to watch that short interest data. If you see that 23% figure start to drop significantly, it means the bears are closing their positions and giving up. If it holds steady or grows, it means they're digging in for the next fight. Comment below with what you think. Is this new AI focus at Opendoor a real strategic shift, or is it just a marketing buzzword to pump the stock? The story of Opendoor is no longer just about the housing market. It's about a high-stakes bet on a corporate turnaround amplified by a massive short position and a vocal retail trading community. The old expectation was failure. The new reality, at least for yesterday, was a powerful reminder that the market can change its mind in an instant, and that the disconnect between those two is where the most volatility and potential opportunity is found.